Berkshire Hathaway paid $1.02 billion for its position in a single company in 1988. It now collects approximately $776 million from that same position every single year. Not from selling it, from owning it. And the man who made that decision has never sold a single share. Most people who hear that number assume it required extraordinary intelligence, insider access, or a level of financial sophistication that puts it permanently out of reach. This video is about why that assumption is wrong, and about the specific three-question framework that produced that result, because the framework is not complicated, not secret, and not reserved for anyone in particular. In the autumn of 1988, a 58-year-old man from Omaha, Nebraska, began quietly buying shares in a company that sold sugar water. He was already one of the most closely watched investors in America, which meant that when word spread, the reaction from Wall Street was not admiration. It was confusion, and in some corners, something close to ridicule. The company he was buying had just spent 3 years recovering from one of the most embarrassing product failures in corporate history. Its stock had been flat for years. The analysts who covered it had concluded, nearly without exception, that this was a mature business in a mature market, that its best decades were behind it, and that the growth investors wanted was simply not coming from a company selling the same drink it had been selling since 1886. He bought anyway. Over 1988 and 1989, Berkshire Hathaway invested approximately $1.02 billion, acquiring roughly 7% of the company. He has never sold a single share. On April the 23rd, 1985, the company announced it was changing its formula. The decision had been years in the making. A rival had been running its Taste Challenge campaign since the late 1970s, inviting shoppers to taste 2 unlabeled cups of cola and choose which one they preferred. More often than not, people chose the rival. Internal taste tests confirmed it. In blind tests, the new sweeter formula the company had developed beat both the original and the rival. The data was clear. The science said change the formula. What the data could not measure was what this drink actually was to the people who drank it. It was not a taste. It was a memory. The drink at every birthday party, every holiday gathering, every summer afternoon that had ever meant something. The formula was not just a recipe. It was a thread running through decades of personal history, and when the company announced it was cutting that thread, the response was not disappointment. It was grief, expressed loudly, publicly, with an intensity that surprised everyone inside the company who had believed the taste test data told the whole story. Within weeks, the company received more than 400,000 letters and phone calls from customers demanding the original formula back. A psychiatrist hired to listen to the calls reported that people sounded as if they were talking about a death in the family. A man in Seattle formed a group called Old Cola Drinkers of America and threatened a class action lawsuit. Cases of the original drink were being hoarded in basements across the country, and the going rate on the secondary market had tripled. 79 days after announcing the new formula, the company brought the original back. The episode was a humiliation. Every business school in America added it to their curriculum. The press was merciless. The company's leadership spent the remainder of 1985 and most of 1986 in damage control. The man from Omaha watched all of this, and he reached a conclusion that ran almost opposite to what most observers were reaching. Most people saw a company that had nearly destroyed itself through arrogance and mismanagement. He looked at the same events and saw something else. He saw a company that had just conducted, at enormous cost and public embarrassment, the most comprehensive proof of brand strength in the history of consumer products. No marketing campaign, No advertising spend, no focus group could ever demonstrate the depth of consumer loyalty the way this disaster had. The company tried to take the product away from its customers. Its customers refused to let it go. That refusal told him exactly what kind of business he was looking at. And it told him something else. It told him the price might finally be right. To understand why he bought, you need to understand the framework he had been developing since the early 1960s, because it does not begin with the question most investors begin with. Most investors look at a company and ask, what are the earnings right now, and what will they be next quarter? He asks a different question. What is this business actually selling? And will people still want it in 10 years, in 20 years, in 50 years? This sounds simple. It is not simple in practice, because answering it requires a different kind of analysis entirely. You are not reading spreadsheets. You are reading human behavior, what people want, why they want it, and how durable that wanting is over time. He calls the answer to this question a moat. The moat protects a business from competition. The most powerful kind is what he calls a consumer monopoly, a product so embedded in people's habits and emotions that competitors cannot easily take its customers away, regardless of how aggressively they price or how much they spend on marketing. This company had, in his analysis, the strongest consumer monopoly he had encountered, not because of the taste, not because of the formula, because of something far harder to replicate. 100 years of emotional history with its customers. Distribution infrastructure built across virtually every country on Earth over decades. A brand that existed in consumers' minds not as a preference but as a habit, the kind that does not require a decision each time it is acted on. When you reach for this drink, you are not weighing competing beverages. You are following a groove worn into your behavior by years of repetition and association. That groove is the moat. Moats of that depth are built in generations, not years, and once built, they are very difficult to destroy, as the disaster of 1985 had just demonstrated at considerable expense. In 1988, the company was selling approximately 8 billion servings of its products per day. He did not look at that number the way most analysts looked at it. He looked at it as a baseline, and the question he asked was whether the total number of daily servings consumed globally was likely to grow over the next 20 years. The answer, when you think about it clearly, is not complicated. The world's population was growing. The middle class in developing economies was expanding at a rate with no historical precedent. And as those populations moved into circumstances that allowed for discretionary spending, their consumption patterns were shifting toward exactly the kinds of branded consumer products this company sold. The addressable market was not static. It was expanding, decade by decade, in ways that were visible to anyone willing to look at demographic data rather than last quarter's earnings report. He saw a company with an unassailable competitive position, a brand that had just proven its depth under pressure, and a market that was going to grow for decades regardless of what happened to any one country's economy in any given quarter. The price he paid, roughly 5 times book value, was considered expensive for a mature consumer goods company in 1988. He was not buying a cheap stock. He was paying a premium for a business whose earning power, compounded over 20 or 30 years, he believed would make the price he paid look trivial in retrospect. He was right. The framework has 3 questions. All 3 must be answered honestly before a decision is worth making. First, does this product or service address a need or desire that is durable, not fashionable, not currently popular, durable, something people will want in 10 years for the same reasons they want it today? This company addresses thirst, the desire for a moment of pleasure, the comfort of familiarity. These are not trends. They are constants. Second, Does the business have a structural advantage that prevents competitors from easily taking its customers? It is not enough for a product to be good. It must be protected by brand, by distribution, by habit, by switching costs, by some combination of factors that makes moving to a competitor feel like more trouble than it is worth. Third, is the price I am paying reasonable relative to the earning power this business will have over the long term, not just next year? This is where most investors stop thinking and start hoping. He calculates, specifically and conservatively, what a business will earn over a decade or two under reasonable assumptions, discounts those earnings back to present value, and pays less than that. The gap between what he pays and what he calculates the business to be worth is his protection against being wrong. When he ran those 3 questions in 1988, the answers were clear. He bought. Through the 1990s, as the global middle class expanded, and the company deepened its presence in markets that had previously been underpenetrated, its earnings grew at rates that surprised analysts who had written it off as a mature business. By the mid-1990s, the $1.02 billion investment had grown to more than $10 billion in market value. 10 times the money in roughly 7 years, from a company Wall Street had considered boring. But the more interesting part of the story is not the capital appreciation. It is the dividend. When he bought in 1988, the company paid a dividend of roughly 7.5 cents per share per quarter. That dividend has been raised every single year since. By 2024, the quarterly dividend had grown to 48.5 cents per share. The annual dividend income from the original position is now approximately $776 million per year. Berkshire paid approximately $1.02 billion for its entire position. It now collects roughly $776 million from that position every single year. The annual income has approached the original cost of the investment itself. The position has become a machine that generates money indefinitely, from a decision made on a morning in 1988 when a man from Omaha asked 3 questions and liked all 3 answers. After the position was built in 1988 and 1989, the stock did not immediately validate the thesis. Through 1990, as recession concerns mounted and consumer spending softened, the stock declined. The position was worth less than what was paid for it. If you had bought on the same thesis and were watching a daily brokerage statement, you would have seen red numbers. You would have felt the particular discomfort of believing you were right while the market told you otherwise. He did not sell. He sat with the discomfort and waited, because a declining stock price and an invalidated long-term thesis are entirely different things, and confusing them is one of the most expensive mistakes an investor can make. This ability to distinguish between short-term price movement and long-term business reality is not a personality trait. It is a discipline developed by being clear, before you make a decision, about exactly what would cause you to change your mind. He knew, when he bought, precisely what would constitute evidence that his thesis was wrong: a fundamental deterioration in brand strength, a structural change in the competitive landscape, a shift in consumer behavior away from the category entirely. None of those things happened in 1990 when the stock declined. The price was the market's opinion. The business was the reality. He trusted the reality. By 1993, 5 years after the initial purchase, the position had more than tripled. By 1998, 10 years in, it had grown to more than $13 billion. There is one more thing worth understanding about this decision, and it is the thing most people miss. He did not act on this analysis the moment he formed it. He watched this company for years before buying. The reason he did not buy earlier was not that he lacked the analysis. It was that the price was not right, and he was not willing to pay a price that did not give him an adequate margin of safety regardless of how confident he was in the business. The disaster of 1985 gave him the price he needed. The public humiliation had depressed investor sentiment sufficiently that by 1988, the stock was trading at a multiple he considered reasonable. He needed both things, the proof and the price. In 1988, for a brief window, he had both. The framework he used is not reserved for billionaires or professional investors. It is available to anyone willing to ask the right questions and wait for the right answers before committing. Before any significant financial decision, whether it is a stock purchase, a business investment, a career move, or a decision about where to put your savings, ask the three questions. Does this address a need or desire that will be as real in 10 years as it is today? Is there something structural that protects this opportunity from being easily taken away by competitors or circumstances? And is the price you are paying reasonable relative to what this will be worth over a long time horizon, not just next year? $1.02 billion. 3 questions asked honestly. 1 decision made patiently. Now worth approximately $25 billion and generating approximately $776 million in annual income. The question is not whether you have $1.02 billion. The question is whether the decision you are about to make with your money has been through those 3 questions yet. And if it has not, why not? Next video on this channel examines a different kind of decision, one where the person knew they should start, knew exactly what it would cost them not to, and still found a reason to wait. What does that wait actually cost in real numbers over a real lifetime? That video is next. Signing off, David Hangrove.